Have you ever wondered how investments work? Have words like stock market and online investing been thrown into your conversations and you're often left wondering what it all really means? Well, before we go into more detail about how investing works, let's first talk about the why. So, why do we invest? The main reason why we invest is to ensure that when the time comes, we can purchase the things we really want, live comfortably when we retire, and make our money work for us. By investing your money, you're getting your money to generate more money by earning interest on what you put away, or by buying and selling assets that increase in value. Now that we know why we invest, let's discuss how to get started with investing. Step 1. Set your investment goals. Before you're ready to start investing, you need to first figure out why you're investing. List down all your goals, list out the things that you want to do in your life, focusing on those big moments that come with a price tag. A good idea is having a timeline to help you organize your goals and future plans. Step 2. What type of investment would you need? Knowledge is power. It helps to know the difference between the most common types of investment instruments, shares, bonds, and unit trusts. So, what are shares? When you invest in shares, you are essentially loaning money to a company to expand, grow, or invest in research. Provided that nothing bad happens, like bankruptcy, you sell the shares at a higher price than what you purchased them, and receive cash, what you invested and the growth of that share, in return. Now the question rises, how does investing in shares work? As an example, you might purchase shares in Company X, where the share price is $100. 6 months later you may sell those same shares at $125 per share as the share has increased in value. On conclusion of the sale you should get your $100 per share, plus the $25 per share growth. Remember, there are certain costs that may be incurred in the trade, for example trading fees and tax. Now we know about shares, but what about bonds? What are bonds? A bond represents money loaned to the bond issuer. Typically, the bond issuer promises to repay the entire principal loan amount on a future day, known as the maturity date, and pay interest income in the meantime based upon a coupon rate. And finally, what are unit trusts? In layman's terms, this is a pile of money that comes from a lot of investors like you and is then invested in assets like shares and bonds. A unit trust fund may hold a variety of shares, with the purpose of spreading the risk. These unit trust funds are managed by portfolio managers. Now, the point to be noted is that investing is different to saving, and with that note we have already discussed the step 2. Now in step 3, you need to learn the investment strategies. Get knowledgeable on the stock market and the strategies. Often, you'll get told to put most of your money in shares. But if you read the financial page, you know that the stock market can take big dips and unpredictable jumps. Investing directly in shares can be risky. So, choose what you feel is best for you and remember your financial advisor will be able to guide you. With that we come to step 4, time to build your portfolio. Your investment portfolio consists of all your individual investments in shares, bonds, unit trusts, and other instruments. Diversity is key. The idea is to invest in enough different sectors of the economy so that if one investment does poorly, your other investments will make up the difference. If you have too many of your eggs in one basket, you could end up increasing your risk. A diversified portfolio spreads the risk evenly so that no single mistake will ruin everything. And finally, step 5, happy investing. If you've done your homework and are keen to start investing online, then do your research and find the best suited investment option for you to start on with your first investment.